Welcome back to the channel, guys. In this video, I'm going to simplify and break down the market maker buy and sell model. This should be a real nice, quick, and easy video, guys, so let's get into it. So MMXM just is a variable for market maker buy model or market maker sell model, and I'm going to quick give you guys a little demonstration or illustration of what it looks like and how it works, and then we'll go look at an example on the chart from this trading week. So the way that the market maker buy or sell model works, I'm going to show you guys an example actually, I guess, using the market maker buy model more than anything. But the way that this works, the first thing I'm going to draw out and annotate is the market maker sell model. So the way that this will work is you have your original consolidation or your original manipulation, right? So you have your original consolidation or your original manipulation that begins the sell side of the curve, right? So you got the sell side of the curve. During this curve, you're going to have price putting in bearish order flow. So you're going to have price putting in lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, right? Just like normal when you have bearish structure in place. And what you're anticipating, guys, is you're anticipating price to come down to a higher time frame bullish PD array. Now, this bullish PD array could be in the form of an order block. It could be in the form of a higher time frame inefficiency, a higher time frame breaker, a discount or a premium of a price range. Whatever it is, you're looking for that higher time frame bullish PD array to let price deliver down to on the sell side of the curve. And then when it gets down to whatever that bullish PD array would be, you are going to be looking for your smart money reversal to take place to create and begin the buy side of the curve going back the other direction. So this is what you're going to be anticipating, guys, to play out. And when you see price get down to that bullish PD array, you're not just firing longs or shorts if it's going the other direction. You're anticipating there to be reversal. So some of you might be asking, well, what is a smart money reversal? Well, really the easiest one that you could look to would be a market structure shift, right? So when price breaks above this short-term high, that is known as your market structure shift, where you get a change in the state of delivery where price went from creating bearish order flow and bearish price action to then flipping and becoming bullish in terms of price delivery and the price action that is being printed. And what you're going to want to do, guys, you're going to be anticipating this smart money reversal. And then once this happens, that is when you can begin hunting bullish PD arrays in order to start going long. So one of the easiest and one of my favorite PD arrays that I like to hunt would be the fair value gap. So what I like to do is look for fair value gaps inside of these price legs to start hunting for longs. And when price pulls back to these zones, boom, you can grab your entry and set your stop loss below whatever that recent low would be or below the fair value gap candle. Just all depends on you. You don't have to use fair value gaps. You can use order blocks. I just like using fair value gaps as my preferred entry model. And then when price goes ahead and starts breaking structure to the upside, same thing can be said when price pulls back. Again, this could be where you would pyramid an entry. This could be where maybe you missed the initial move. You could look for a re-entry, because here's the deal, guys. When price goes ahead and mitigates these areas and then goes ahead and breaks structure again, this low should now become a protected low. This low should no longer become a low that gets breached if you've identified this model correctly. So same thing here again. You would expect price to come back down, mitigate that gap, and then make another push to the upside. And the whole goal of the buy side of this curve is every single one of these old highs become liquidity for the buy side of the curve, because this entire movement down, guys, is just engineering liquidity to be taken out later when the market shifts back to the buy side of the curve. Because as price is going down, we know that people are trailing their stop losses, putting their buy stops above these highs, whatever it might be. So when the market comes back, it's going to recognize all of this as liquidity, orders resting that need to be triggered to get people into the market or out of the market, whatever it is. And then this is where you're looking for your entries. After the smart money reversal, you really have two solid opportunities to get in where you can anticipate these lows to be protected. Once you kind of start getting in at the later end of the curve, it becomes a little bit lower probability, and you do run the susceptibility to maybe get ran out as price maybe pulls back for a higher time frame inefficiency, just depending on the time frame that you're looking at. But you're anticipating price to then go ahead and take out the full original accumulation. You're assuming it'll take out the beginning of this entire move, right? And then one other thing that I'm going to show you guys on the charts that might illustrate this a little bit better, but I like to use standard deviations. And one of the best ways that you can apply this to help you find your targets and find how everything kind of lines up, you'll see a lot of times when you use the standard deviation, you draw your fib from the swing high to the swing low of whatever the manipulation move is. Oftentimes that 2 to 2.5 standard deviation should line up with wherever that smart money reversal is going to come into effect. And the same will be true usually when drawing up the manipulation from the other side. That 2 to 2.5 standard deviation will almost always line up with the beginning of that first original consolidation, that original accumulation, and the manipulation move that started this entire model off. So this was just a quick little crash course on what the market maker buy and sell models will look like. This is showing you the market maker buy model coming out of bearish order flow. But if you're looking at this inversely and you're looking at it from the sense of a buy model turning into a sell model, guys, it's literally this exact same thing, just flipped upside down. And with that being said, let's dive into an actual chart example from a trade that we took this week. And if this video is helping you guys so far, I would ask you to consider leaving a like and subscribing to the channel. It does help a lot. But with that being said, let's go ahead and move up here and take a look at the trade that we took on Wednesday of this week. So this actually ended up playing out during Wednesday during PM session. We took the AM session trade to the downside. And what I'm going to illustrate for you guys here really quick is a couple different things. So I'm actually going to jump into replay mode first and foremost, so we can kind of get a actual feel for how this should look. I'm going to delete some of these drawings that are already on here, but we're going to take this and pick this up from the actual rounding of that curve, right? Where the price shifts from a sell side of the curve to a buy side of the curve, and we actually shift and have that smart money reversal. So the trade that happened during AM session on Wednesday was this sell-off, right? So you guys can see, if I drop down to a 1 minute chart, you guys can see how this looks. And if I were to show you guys that manipulation move from this swing low to this swing high that swept liquidity, so this is that original consolidation that we were talking about. The original consolidation is right here, or the original manipulation. You can word it however you would like. That's going to make the most sense to you. And then this is what then creates that sell side of the curve, right? So this is that sell side of the curve where price is putting in lower lows, lower highs, bearish order flow. And then where does it go to? It comes down to the 2 to 2.5 standard deviation, yes, but what is also at that standard deviation level? If we jump up to the 1 hour chart, we know that we want to look for the best longs in discounted price ranges. So on this 1 hour chart, from this swing low to this swing high right up here, this is actually equilibrium. So this is a discounted price range of the last impulsive move to the upside. So I was already anticipating that once price got down to equilibrium, to discount, and to this 2 to 2.5 standard deviation from the original move, I was anticipating there to be a potential for a smart money reversal to then possibly look to go long, right? But I'm waiting for that move. I'm waiting for that setup. So as price is playing out here, keep in mind, right at this very moment in time, this was during New York lunch. So New York lunch is from 12 to 1. And my rule personally is I don't look to take trades during this time. I'm only looking to take trades if I'm seeing a setup outside of this window. So whether it's in the AM session or in the PM session, but I'm usually just not taking a trade during lunch. It's just a rule that I have. You don't have to follow that same rule. It's just my personal rule for myself. So as we fast forward here to the end of New York lunch, I will show you guys where we're hunting the setup. So first and foremost, just because I'm only looking to enter during PM session after New York lunch, that doesn't mean that I can't use the price action that formed during lunch to help frame and find that entry. So based off of what I showed you guys down here in that illustration, this is where you would be looking for that smart money reversal, because what are you waiting for? You're waiting for a market structure shift. We have that right here. When price bounces off equilibrium, comes up, chops around, creates some accumulation right here. We put in a swing high, and then that swing high is traded through with displacement to the upside. So this now becomes that bullish market structure shift. So what are we doing for looking for an entry, right? We're looking for this fair value gap, the one that is actually in a discounted price range, even of this last impulsive leg for that possible entry. But we want to see that entry happen after New York lunch or right at the very end of, New York lunch. So just showing you guys how this plays out. Price comes down and it taps that fair value gap. Nice reaction out of it. If you were entering this fair value gap, your stop would be below this recent swing low, because this should become a protected low, right? So now you're watching price, seeing how it plays out. Full disclaimer, this is not the trade that we caught. I was not on the charts just yet. The only way I would have caught this move is if I would have been on the charts right as lunch ended, because it triggered in at 1:02 p.m., 2 minutes after the lunch hour ended. But waiting for another opportunity here, we see a fair value gap forms right there. Perfect. This was actually the entry that we ended up catching. So again, same exact concept here. I am anticipating that this little poke down into this fair value gap, sweeping this liquidity, mitigating this. This now becomes a protected low. This, if I have identified it correctly, should not be disrespected. It should not be traded back through until we've gone and delivered through all of these levels of liquidity that now need to be taken out. So if I were to draw these lines across, boom, liquidity right there. We've got another high right here in the form of liquidity, right there. And then last but not least, we've got the actual original manipulation, which started this entire thing off. So this was the trade that we framed up and caught, guys. And this is how we did it. Stop below this low, using this fair value gap as entry. Now, again, if you don't want to use the fair value gap and you want to be a little bit more picky and use the order block, you can do that. You might not always get picked up, but in this specific example, you guys will see that you definitely would have. So totally up to you how you want to manage the trade. Do you want to get out here? Do you want to hold all the way to the end? Totally up to you. It also depends if you're trading, futures, if you're holding the trade overnight, things like that. But lo and behold, this is what happens. Price comes down, taps us in right there. Nice reaction initially. It does come down to that order block, a little bit of drawdown, but then price soars, flies to the upside, and then eventually, ultimately, we end up taking out TP1. We take out TP2, come back down and draw down a little bit, sweep some internal buy side liquidity before eventually leading into the overnight session. I'll play this out for you guys just so you guys can get some reward for sitting here and watching. It's always good to see it finish all the way out. But this actually ended up playing out overnight and didn't sweep until this morning's opening bell. So finally, price goes up and eventually completes this model right here at opening bell, and then absolutely melts pretty much the rest of the day. So that was this entire market maker model playing out from start to finish, sell side of the curve, and then this buy side of the curve took a little bit longer than maybe some setups would, but ultimately this entire move ends up playing out before the actual reversal to the downside ends up happening. So dropping back down here to the 1 minute chart, the last thing that I would like to show you guys when it comes to this setup, last but definitely not least, is kind of this cherry on top with the standard deviation. So I showed you guys how the flip from the sell side of the curve to the buy side of the curve happened with this 2 to 2.5 standard deviation. Well, watch this. So if I take that same fib, I go from the swing low of that manipulation to the swing high, just this very last manipulation down before everything turned. If I go up, the 2 to 2.5 standard deviation is lined up right over this liquidity from the very original manipulation. So with all that being said, guys, I would say the biggest thing that's going to help you the most is being able to get good at identifying the higher time frame draw on liquidity, the higher time frame bullish or bearish PD array that you can play off of. Because at the end of the day, guys, the market's fractal, and you're going to see this market maker buy and sell model play out on pretty much every time frame all the time throughout the day. But the best moves that you're going to be able to catch and have be completely painless for you are going to be the ones where you've identified and been anticipating the reversal to take place at a higher time frame bullish PD array and inefficiency and order block, whatever it might be. And then when price gets to these levels and then gives you that reaction that you've been waiting for, all you have to do is execute. So again, hopefully you found this video helpful in some way, shape, or form, guys. Hopefully it helps you in your trading. I wish you nothing but the best. Let me know if you have any thoughts, comments, or questions below, guys, and I will see you in the next one. Peace out.